The metal moved, and then something strange happened. Not just a price surge, but a wave of panic from the people who sold. They're watching the screens now, hands shaking, wondering if they just made the biggest mistake of their financial lives. Because what's happening in Shanghai, what's quietly unfolding in the physical vaults, what the institutions are doing while retail investors sleep, it's not showing up on your brokerage app. The gap is widening, the premiums are screaming, and the people who let go of their silver 3 weeks ago, they're about to learn a very expensive lesson. Welcome to Currency Archive, where we don't chase headlines. We decode the markets before they make the news. If you've been following global capital flows for as long as I suspect you have, then you already know the difference between noise and signal. Do me a favor. If this analysis adds clarity to your strategic positioning, tap that subscribe button. Not for the algorithm, but so you don't miss what happens next. And drop a comment below. Where in the world are you watching this from? London? Singapore? Texas? I'm curious who else is tracking this divergence. The notification arrived on thousands of screens simultaneously. Silver had moved, not the slow, predictable drift traders had grown accustomed to, but a sharp, violent surge that demanded immediate attention. Within hours, a strange phenomenon began unfolding across trading desks, kitchen tables, and brokerage apps worldwide. The people who had sold their silver weeks earlier, the ones who had liquidated during the last scare, were now staring at their empty positions with a sinking realization. They had made a terrible mistake. This was not ordinary seller's remorse. This was something deeper, something more structural. Because the price wasn't just rising on it, it was accelerating. And with each upward tick, the psychological weight on former holders grew heavier. They had convinced themselves they were being smart. They had told themselves they were taking profits, protecting capital, avoiding the next crash. But now, watching silver climb past levels they never imagined it would reach so quickly, they understood the brutal truth. They had traded a strategic asset, like a tactical position, and the market was teaching them an expensive lesson. The numbers told a clear story. Silver had spent weeks consolidating, grinding sideways while analysts debated whether the rally was over. During that consolidation, nervous holders had bailed out. Some cited geopolitical uncertainty, others pointed to technical indicators suggesting weakness. Many simply grew impatient. Unwilling to tolerate the volatility that comes with precious metals ownership, they sold, they moved to cash. They waited for confirmation that they had made the right choice. That confirmation never came. Instead, what arrived was a surge that caught nearly everyone off guard. The price didn't creep higher. It exploded. Large green candles appeared on charts. Trading volume spiked. And suddenly, the people who had been congratulating themselves for getting out at the top realized they had gotten out at the bottom of the next leg up. The regret was immediate. The frustration was visceral. And the questions began flooding in. Should they buy back in? Had they missed the entire move? Was there still time? But here's where the situation became truly problematic. Because when these former holders attempted to re-enter the market, they discovered something unsettling. The metal they had sold so easily weeks ago was no longer easy to acquire. Premiums had widened, delivery times had extended. And in some cases, dealers were simply not offering the same products at any reasonable price. The liquidity that had existed on the way down, the smooth, frictionless ability to exit positions, had evaporated on the way up. This is the hidden cost of panic selling that most investors never calculate. When someone liquidates a hard asset during uncertainty, they don't just lose the rally, they lose the premium they originally paid. They lose the premium they could have captured upon selling during strength. They lose optionality, they lose their position in the queue. And most critically, they lose the psychological advantage of holding through volatility, because once fear drives the decision to sell, confidence becomes difficult to rebuild. Every subsequent price move upward feels like punishment. Every attempt to re-enter feels like admitting defeat. The behavioral economics are straightforward but brutal. Humans are wired to avoid regret. When faced with the choice between buying back at a higher price or waiting for a pullback, most choose to wait. They tell themselves the surge is unsustainable. They convince themselves that a correction is imminent. They create narratives that justify their inaction. But while they wait, the market continues moving. And with each passing day, the psychological barrier to re-entry grows higher. What starts as tactical patience becomes strategic paralysis. This pattern has repeated throughout financial history. Every major commodity surge is littered with the stories of people who sold too early, who mistook volatility for weakness, who confused a consolidation for a top. And silver, with its unique dual nature as both industrial metal and monetary asset, is particularly prone to these psychological ruptures. Because silver doesn't move like stocks. It doesn't respond to earnings reports or dividend announcements. It responds to deeper currents, monetary instability, geopolitical tension, supply constraints, and shifting confidence in paper currencies. What made this particular surge different was the speed and the context. This was not happening in isolation. Gold was moving aggressively. Commodities broadly were showing strength. And in the background, quietly but unmistakably, the physical market was tightening. Reports were emerging from overseas markets showing premiums that made no sense to Western observers. In certain Asian hubs, buyers were paying significantly above the spot price just to secure delivery. That spread, that gap between what screen showed and what physical metal actually cost, was widening. And this is where sellers' regret transformed from personal frustration into strategic warning, because the people who sold were not just wrong about price direction, they were wrong about market structure. They had assumed liquidity was permanent. They had assumed the ability to exit and re-enter at will. They had assumed the paper price on their screen represented reality. But reality, the actual physical reality of metal changing hands, was diverging. And that divergence was about to become impossible to ignore. The surge had only just begun, and the regret, the flood of realization washing over former holders, was about to collide with a supply situation that had been quietly deteriorating for years. There are two silver markets operating simultaneously on this planet. Most investors only know about one of them. They see a price on their screen, a number that updates every few seconds, and they assume that number represents the cost of acquiring actual metal. But in trading rooms across Shanghai, Singapore, and Dubai, a very different reality has been taking shape. The price on the screen and the price of physical delivery have begun living in separate universes. And the gap between them is not closing, it is widening. This is not a glitch. This is not temporary market noise. This is a structural fracture that reveals something deeply uncomfortable about how silver pricing actually works. Because for decades, the global price discovery mechanism for silver has been dominated by paper contracts, futures, options, ETFs, and synthetic products that promise exposure without requiring actual metal to change hands. Billions of dollars flow through these instruments daily. Traders buy and sell positions with a keystroke. Leverage amplifies movements. And the price that emerges from this paper ecosystem becomes the official silver price that the world references. But there is a problem. Paper contracts can be created infinitely. Physical metal cannot. And when demand for actual deliverable silver begins exceeding available supply, the paper price and the physical price start to decouple. This decoupling is exactly what sophisticated buyers in Eastern markets have been exploiting for months. While Western investors trade silver on screens, Eastern institutions have been quietly accumulating the physical metal itself, and they have been willing to pay premiums that would shock most American investors. Recent data from the Shanghai Gold Exchange revealed something striking. The price for physical silver available for immediate delivery in China was trading at a persistent premium above London and New York spot prices. Not a small premium, not a temporary spike, but a structural sustained spread that indicated something fundamental had shifted. In some instances, buyers in Shanghai were paying 8 to 12% more than the COMEX spot price just to secure metal. That premium represented real capital, real demand, and real scarcity that the paper markets were simply not reflecting. This phenomenon extends beyond China. Reports from bullion dealers in Singapore, India, and the Middle East showed similar patterns. Customers were encountering extended delivery windows. Popular products were listed as temporarily unavailable or pre-order only. Mints were operating at maximum capacity, but still falling behind demand. And the premiums, those extra dollars buyers had to pay above spot price, were not compressing despite higher prices. Normally, when silver rallies, premiums shrink because the percentage markup becomes less significant. But this time, premiums were holding firm. In some cases, they were expanding. The explanation lies in understanding what physical silver actually represents in these markets. For Western retail investors, silver is often viewed as a speculative trade, a momentum play, something to flip for profit. But in many Eastern markets, silver serves a different function entirely. It represents monetary insurance. It represents wealth preservation outside the banking system. It represents a hedge against currency instability that does not require permission from any government to own or transfer. This cultural and strategic difference in how silver is perceived creates fundamentally different demand behaviors. When a Western trader sees silver surge and then pull back, the instinct is often to sell, to lock in gains, to reduce exposure. But when an Eastern accumulator sees the same pattern, the instinct is often to buy more, to use the dip as an opportunity to increase physical holdings while others panic. This divergence in behavior creates the premium structure, because the people willing to pay above spot are not trying to time a trade, they are trying to secure a strategic position, and they understand that the paper price is increasingly irrelevant to the actual cost of acquisition. The warehouse data supported this analysis. COMEX registered silver inventories. The metal actually available for delivery against futures contracts had been declining for months. At the same time, eligible inventories, metal stored in COMEX warehouses but not available for delivery, remained relatively stable. This created a situation where the exchange had plenty of silver on paper, but comparatively little available to actually fulfill delivery requests. The ratio of paper claims to physical metal was expanding, and every time that ratio expands, the risk of a delivery squeeze increases. London told a similar story. The London Bullion Market Association reported vault holdings, but the transparency into who owned what and whether it was available for sale remained limited. What was clear from dealer reports was that large bars, the wholesale units that institutional buyers prefer, were becoming harder to source quickly. Retail products like coins and small bars showed even tighter supply conditions. Mints were rationing allocations. Distributors were extending lead times, and premiums were rising despite the higher spot price. Then there was the refinery bottleneck. Silver doesn't just appear in usable form. It must be mined, refined, fabricated into bars or coins, assayed and distributed. Each step in that chain has capacity limits. And when demand surges suddenly, when thousands of buyers simultaneously decide they want physical metal, those capacity limits create delays. Refineries in Switzerland, the United States, and Australia were all reporting extended processing times. The surge in spot price had triggered a surge in conversion demand. Investors who had been sitting in ETFs or futures were now requesting physical delivery. Industrial users were securing future supply, and the entire fabrication pipeline was straining under the load. This is what makes the current situation so unusual. Normally, a price surge attracts new supply. Miners increase production. Recyclers bring scrap to market. Holders liquidate into strength. But this time, the supply response was muted. Mining output grows slowly. It takes years to bring new projects online. Recycling was increasing but could not match demand. And the holders who might normally sell into a rally, many of them had already sold during the consolidation. The ones who remained were precisely the people least likely to liquidate. They were the strong hands, the strategic accumulators, the people who understood what was happening. What was happening was a repricing, not just of silver's dollar value, but of silver's role in the global monetary system. Because as confidence in paper currencies erodes, as debt levels reach unprecedented levels, as geopolitical fragmentation accelerates, physical assets with no counterparty risk become exponentially more valuable. And that value does not show up on a screen until the moment someone tries to convert their paper position into physical metal. That is when the divergence becomes undeniable. That is when the premium becomes the price. The regretful sellers were beginning to understand this. They had sold a paper position easily, but buying back physical metal at a reasonable price was proving far more difficult. The market they thought they understood was revealing itself to be something else entirely, and the gap between perception and reality was measured in percentage points that compounded into real wealth transfer. The question was no longer whether the divergence existed. The question was how long it could persist before something broke. There are moments in financial history when multiple pressure systems converge simultaneously, when monetary policy, regulatory frameworks, and geopolitical tensions align in ways that create unavoidable stress on existing market structures. Silver was now sitting at the exact intersection of three such forces, and each force was pushing in the same direction, toward higher prices, tighter supply, an accelerated divergence between paper claims and physical reality. The first pressure point was monetary. Central banks globally had spent the past 15 years expanding their balance sheets at rates that would have been considered reckless in any previous era. The Federal Reserve alone had increased its holdings from under $1 trillion in 2008 to over $8 trillion at peak. While recent attempts at quantitative tightening had reduced that number somewhat, the structural damage was already done. Trillions of dollars had been created, asset prices had been inflated, and the purchasing power of every dollar in existence had been diluted. This was not theory, this was mathematical certainty. What made the current moment particularly dangerous was the trajectory of real interest rates. Real rates, the difference between nominal interest rates and inflation, determine the opportunity cost of holding non-yielding assets like silver. When real rates are deeply negative, holding cash becomes a guaranteed losing proposition. Holding bonds offers little better, but holding physical metal, holding an asset with no counterparty risk, no default possibility, and 5,000 years of monetary history, suddenly becomes rational. And as more investors reached that conclusion simultaneously, demand for physical silver surged while paper alternatives lost their appeal. The Federal Reserve was caught in an impossible position. Raising rates aggressively to combat inflation risked triggering a debt crisis, given that U.S. government debt now exceeded $35 trillion. Keeping rates too low risked destroying confidence in the currency itself. And every meeting, every policy statement, every piece of economic data released became another data point that precious metals markets analyzed for clues about future monetary stability. The recent surge in silver was not happening despite Fed policy. It was happening because of it. The market was pricing in the reality that currency debasement was no longer a future risk. It was current policy. The second pressure point was regulatory, and this pressure was less visible but potentially more consequential. Basel III, the international regulatory framework for banks, had introduced new rules regarding how precious metals were treated on bank balance sheets. Under the new framework, physical gold held in allocated form was classified as a zero-risk asset, but unallocated gold, paper gold and silver in most forms, did not receive the same treatment. This created a structural incentive for banks to reduce their exposure to paper precious metals and favor physical holdings or avoid the sector entirely. The implementation of Basel III had been staggered globally. Europe adopted portions earlier. The United States delayed certain provisions. But the cumulative effect was a reduction in bank willingness to facilitate large-scale precious metals trading and lending. This meant less liquidity, less ability to move large positions quickly, and less bank participation in the mechanisms that had historically kept paper and physical prices aligned. When banks step back from market making in a sector, price discovery becomes more volatile. Spreads widen, and the risk of sudden dislocations increases. Then there was Executive Order 1.346. Issued quietly with limited media coverage, the order addressed tariff structures and exemptions for certain strategic materials. Buried in Annex 2 was a specific exemption for monetary bullion, gold and silver meeting certain purity standards. On the surface, this appeared technical, but the implications were profound. The exemption created an arbitrage window. It meant that physical silver could move across borders under different tariff treatments depending on form and documentation. And sophisticated operators were already exploiting that window to shift metal from jurisdictions with lower premiums to jurisdictions with higher demand. The Chinese regulatory environment added another layer of complexity. Beijing had recently imposed export restrictions on certain strategic metals critical to technology manufacturing. While silver was not directly targeted, the restrictions created supply chain anxiety that rippled through industrial users. Companies that relied on silver for solar panels, electronics, and medical devices began securing future supply more aggressively. This industrial hoarding behavior intersected with investment demand, compounding the pressure on available inventory. The third pressure point was geopolitical, and this was the accelerant that could turn a tight market into a crisis. The global order that had maintained relative stability since World War II was fracturing in real time. Trade wars were escalating. Military tensions were rising. Alliances were being questioned. And the financial infrastructure that had enabled smooth cross-border capital flows was being weaponized for political objectives. The Trump administration's recent signals regarding NATO funding and alliance commitments had triggered emergency meetings in European capitals. When a sitting U.S. president questions the value of a 75-year-old security alliance, when that alliance represents over $27 trillion in combined GDP, markets pay attention. And one of the ways markets express geopolitical anxiety is through safe haven asset accumulation. Gold and silver benefit from chaos. They benefit from uncertainty. And the current geopolitical landscape was providing both in abundance. The Russia-Ukraine conflict showed no signs of resolution. The Middle East remained volatile. Taiwan tensions were escalating, and in the background, a deeper shift was occurring: de-dollarization. For decades, the US dollar had served as the world's reserve currency, the medium through which international trade was conducted and value was stored, but confidence in that system was eroding. The BRICS nations, Brazil, Russia, India, China, and South Africa, now expanded to include additional members, were actively working to create alternative payment systems and settlement mechanisms that bypassed the dollar entirely. This was not idle talk. Bilateral trade agreements were being signed in local currencies. Central banks in non-Western nations were reducing dollar reserve holdings and increasing gold purchases. And while silver had not yet achieved the same central bank demand as gold, the mechanics were identical. If the dollar's role as reserve currency diminished, hard assets with no political allegiance became more valuable. Silver, with its industrial applications and monetary history, sat at the intersection of both narratives. But there was another geopolitical element that few were discussing openly. Financial sanctions had become a primary tool of Western foreign policy. When Russia was cut off from SWIFT, when Iranian assets were frozen, when entire nations found themselves unable to access the global banking system, a message was sent. That message was simple. If you hold your wealth in the Western financial system, that wealth can be seized or frozen at any moment for political reasons. This realization was driving a fundamental shift in how sovereign wealth funds, central banks, and high net worth individuals thought about asset allocation. Physical silver, stored outside the banking system, could not be frozen by executive order. It could not be sanctioned. It could not be inflated away by central bank policy. It simply existed. And in a world where financial assets increasingly came with political strings attached, that simplicity had value, enormous value. The institutional behavior patterns reflected this shift. Recent analysis of COMEX positioning data showed something unusual. Several large banks that had historically maintained significant short positions in silver, positions that effectively bet against price increases, had dramatically reduced those shorts. In some cases, they had reversed entirely. This was not random. This was strategic repositioning by entities with access to information and analysis far beyond what retail investors possessed. They were reading the same regulatory frameworks, the same monetary policies, and the same geopolitical indicators, and they were adjusting accordingly. JP Morgan's historical case provided context. For years, the bank had been accused of manipulating silver prices through massive short positions and spoofing tactics. Regulatory fines were paid. Behavior ostensibly changed. But the key lesson was not about past manipulation. The key lesson was about timing. The institutions that had suppressed prices for years were now positioned to benefit from the surge they had helped delay. They had accumulated physical metal while keeping paper prices suppressed. And now, as the paper market lost credibility and physical premiums exploded, they were sitting on strategic positions that would generate extraordinary returns. The convergence was undeniable. Monetary policy was forcing investors toward hard assets. Regulatory changes were reducing bank participation in paper metals markets. Geopolitical fragmentation was destroying confidence in traditional financial systems, and institutional players were repositioning ahead of the inevitable conclusion. This was not a typical commodity rally driven by industrial demand or speculative fervor. This was a structural repricing driven by the erosion of the post-war financial order itself. The regretful sellers had missed more than a price move. They had missed a fundamental shift in how the world was beginning to value portable, tangible, politically neutral stores of wealth. And that shift was accelerating. The question that now occupied every serious market participant was deceptively simple. What happens next? But the answer was anything but simple. Because silver was no longer behaving like a predictable commodity with clear support and resistance levels. It was behaving like an asset caught between two incompatible realities: the paper market's perception of value and the physical market's assessment of scarcity. And when those two realities collide with sufficient force, historical precedent suggests three possible outcomes. Each outcome carried distinct implications for anyone holding positions, anyone who had sold, and anyone still deciding whether to enter. The first scenario was parabolic continuation. History provided clear examples of what this looked like. In 1980, silver reached $50 per ounce in a frenzy driven by the Hunt brothers' accumulation strategy and Cold War monetary instability. In 2011, silver briefly touched $49 amid quantitative easing concerns and sovereign debt crises. Both episodes shared common characteristics: rapid price acceleration, massive volume surges, retail participation reaching fever pitch, and premiums on physical products expanding to levels that made rational analysis nearly impossible. If the current surge followed that pattern, technical analysts were already mapping potential resistance zones. The psychological barrier at $50 would be formidable, not because of any fundamental reason, but simply because human psychology treats round numbers as meaningful. Beyond 50, the next significant level would be the inflation-adjusted 1980 high, which, depending on the calculation method used, ranged between $130 and $150 per ounce. Reaching that level would require sustained institutional buying, continued physical market tightness, and a complete loss of confidence in paper price discovery mechanisms. But parabolic moves carry inherent dangers. The velocity of ascent often determines the violence of the eventual correction. Retail investors who chase price momentum during the final stages of a parabolic move become the liquidity providers for early buyers seeking exits. The emotional pattern is predictable. Fear of missing out drives buying at precisely the moment when risk is highest. Then, when the inevitable pullback occurs, panic selling creates the cascading losses that wipe out late entrants. The regretful sellers from the recent consolidation could easily become regretful buyers if they re-entered during euphoric price action, only to experience another sharp reversal. The second scenario was consolidation and premium normalization. In this outcome, silver would digest recent gains through time rather than price. The surge would pause, volatility would decrease, and the market would enter a ranging period that allowed supply chains to catch up with demand, premiums to compress, and new equilibrium pricing to establish itself. This scenario assumed that current demand was not sustained panic buying, but rather a structural shift in allocation preferences that would persist at lower intensity. Historical precedent suggested that healthy bull markets in precious metals advance in stages: sharp rallies, followed by months-long consolidations, followed by new rallies to higher levels. This stair-step pattern allows weak hands to exit, strong hands to accumulate, and fundamental narratives to develop supporting evidence. If silver followed this pattern, the current premium levels in physical markets would gradually decline as mints increased production, refineries expanded capacity, and dealers rebuilt inventory. The paper-physical spread would narrow but not disappear entirely. For current holders, this scenario offered the most favorable risk-reward profile. It provided time to evaluate positions without the pressure of parabolic volatility. It allowed for strategic profit-taking on portions of holdings while maintaining core positions. And it created opportunities to add to positions during pullbacks without the fear that the entire move had ended. But consolidation requires patience, and patience is the scarcest commodity in modern markets. Most participants would interpret sideways price action as confirmation that the rally was over, leading them to exit positions that might have been strategically valuable to maintain. The third scenario was the one almost nobody wanted to discuss openly, but everyone needed to consider. Regulatory intervention, or forced liquidation. Governments have a long history of intervening in precious metals markets when price movements threaten monetary stability or political narratives. The most infamous example was Executive Order 6102, signed by Franklin Roosevelt in 1933, which required U.S. citizens to surrender gold holdings to the Federal Reserve in exchange for paper currency at a fixed price. Silver faced similar restrictions during various periods of the 20th century. Could such intervention occur again? The legal framework existed. The Emergency Economic Powers Act granted the executive branch broad authority to regulate commodity markets during declared emergencies. The question was not whether intervention was legally possible, but whether current conditions would justify its use. If silver's surge was perceived as threatening financial stability, if it was creating losses for systemically important financial institutions with short positions, if it was undermining confidence in the dollar itself, then intervention became a realistic scenario. But intervention in modern markets would face complications that did not exist in 1933. Global ownership of silver was far more distributed. Digital markets allowed for rapid cross-border transfers. And any attempt to confiscate or restrict silver in one jurisdiction would simply drive premiums higher in jurisdictions that did not comply. The likely form of intervention would be more subtle. Position limits on exchanges, margin requirement increases, tax policy changes that discouraged physical ownership, or simply regulatory ambiguity that created legal risk for large holders. The probability assessment for each scenario remained uncertain. Markets do not operate in isolation from human decision-making, political pressures, and unforeseen events that can shift trajectories instantly. But the framework for thinking about what comes next required understanding the range of possibilities, rather than anchoring to a single expected outcome. Within this framework, the question of price targets became relevant but secondary to the question of strategic positioning. Analysts were publishing projections ranging from conservative estimates of $60 per ounce to aggressive targets exceeding $200 based on gold-silver ratio reversion models. The gold-silver ratio, the number of silver ounces required to purchase 1 ounce of gold, had historically averaged around 15 to 1 over centuries. Currently, that ratio sat closer to 80 to 1. If silver were to revert to historical norms while gold maintained current levels around $2,700 per ounce, silver would need to reach $180. But ratio reversion was not guaranteed. It was simply a statistical relationship that had held over long time periods. In the short term, ratios could remain distorted indefinitely, especially if the forces driving gold differed from those driving silver. Industrial demand for silver, energy transition applications in solar panels and electric vehicles, and supply constraints from mining depletion all created independent variables that did not apply to gold. These factors could accelerate silver's move or constrain it depending on how they evolved. The more pressing concern for decision makers was not the ultimate price destination, but the liquidity conditions during the journey. And this is where recent real-world data provided sobering context. Reports from bullion dealers during previous silver surges revealed a pattern that most investors never anticipated. When retail holders decided to sell into strength, when they attempted to liquidate positions to capture profits, they discovered that dealer buyback prices did not match the spot prices they saw on screens. During the last major silver spike, investigative analysis found that coin shops were offering buyback prices $10 to $20 below spot. Some dealers were not purchasing 90% silver coins at all. Others were not accepting silver rounds. Several wholesalers and refiners had temporarily stopped purchasing from retail altogether because they were already holding more inventory than they could process. The shops that remained open for buybacks were only able to stay liquid by offering prices significantly below market because they had no immediate outlet for the metal they were acquiring. This created a cruel irony. Investors who had congratulated themselves for holding through volatility and waiting for higher prices discovered that actually converting their holdings to cash required accepting massive discounts. The liquidity that existed on the way up, the ease with which they could have sold at lower prices, evaporated during the euphoric peak when everyone simultaneously wanted to exit. The bid-ask spread that normally measured pennies suddenly measured dollars, and the theoretical value of their holdings diverged sharply from the realizable value. This reality demanded a different strategic framework entirely. Physical silver was not a day trading vehicle. It was not suitable for market timing strategies that required frequent entries and exits. It was a strategic position that served specific portfolio functions: wealth preservation, monetary insurance, protection against currency debasement, and portfolio diversification uncorrelated with traditional financial assets. Treating it as anything else introduced risks that most holders were not prepared to manage. For current holders, the strategic decision framework centered on position sizing and time horizon alignment. Holdings should represent a percentage of total wealth that the individual could tolerate, seeing fluctuate violently without triggering emotional decision-making. That percentage varied based on personal circumstances, but historical guidance suggested somewhere between 5 and 20% for those who understood and accepted precious metals volatility. Anything beyond that range introduced concentration risk that could force liquidation at inopportune moments. For regretful sellers contemplating re-entry, the framework required brutal honesty about what had changed since their initial exit. If the reason for selling was fundamental, a belief that silver's long-term value proposition had deteriorated, then re-entering simply because price had risen made no logical sense. But if the reason for selling was emotional, fear triggered by headline volatility or short-term price action, then the fundamental case for ownership likely remained intact. The question was whether re-entering at higher prices with smaller position sizes made more sense than remaining on the sidelines entirely. For new entrants evaluating whether to establish positions amid established momentum, the challenge was distinguishing between rational allocation and emotional capitulation to fear of missing out. Dollar cost averaging, systematically purchasing fixed dollar amounts over extended time periods regardless of price, remained the most defensible approach for those without the expertise to time entries. Attempting to buy dips in a strongly trending market often resulted in waiting indefinitely while prices continued rising. But buying aggressively at local peaks during parabolic moves often resulted in holding underwater positions through prolonged consolidations. The final strategic consideration transcended price entirely. It focused on the nature of what silver represented in an increasingly unstable monetary system. Every major fiat currency in history had eventually failed. Every government that gained the ability to create unlimited money had eventually abused that privilege. And every population that trusted paper promises over tangible assets had eventually learned painful lessons. These were not opinions. These were historical facts spanning thousands of years and hundreds of societies. Silver's behavior during the current period was not occurring in a vacuum. It was occurring against the backdrop of unprecedented global debt, aging demographics that made debt repayment impossible, political polarization that prevented fiscal discipline, and central banks that had exhausted conventional policy tools. The combination created conditions where the distinction between investment and insurance became meaningless. Holding physical silver was both. It offered potential appreciation if monetary instability accelerated, and it offered wealth preservation if traditional financial systems experienced disruption. The regretful sellers had learned this lesson the expensive way. They had treated silver as a trade when they should have treated it as a strategic position. They had responded to volatility with fear when they should have responded with discipline. And they had prioritized short-term comfort over long-term wealth preservation. The market did not care about their regret. It simply continued moving, indifferent to who was positioned correctly and who was not. What happened next for silver remained uncertain. But what was certain was this: the divergence between paper claims and physical reality was widening. The confidence in institutions that had maintained monetary stability for decades was eroding, and the number of people questioning whether their wealth was genuinely secure in traditional formats was growing. Silver was not just moving because of supply and demand mechanics. It was moving because the world was changing. And those who understood that change early, who positioned accordingly despite volatility and doubt, would be the ones who preserved wealth through the transition. The lesson was not about predicting the exact path forward. The lesson was about understanding the forces in motion and aligning positions with structural reality rather than temporary price action. Because in the end, sellers' regret was not about missing a rally. It was about misunderstanding what was being repriced. And what was being repriced was trust itself.